Koze Pips Academy, Trading Disclaimer. Koze Pips Academy is a service-based business providing trading education, tools, and market analysis from experienced traders. Everything shared in this session, chart breakdowns, potential setups, entries, and levels, reflects our own trading activity and professional opinion. It is for educational and informational purposes only. We are not financial advisors, and nothing shared here constitutes financial, investment, or trading advice. These are high-probability setups we are personally engaging in as traders, not recommendations or guarantees of profit. Trading Forex and other financial markets carries substantial risk, including the potential loss of your entire investment. Past performance is not indicative of future results. You are solely responsible for your own trading decisions, and should only trade with capital you can afford to lose. By participating in this session, you acknowledge that Koze Pips Academy, its analysts, and affiliates are not liable for any losses incurred based on information shared here.
All right, you could get this party started. Let's do it. So for gold right now, before we really jump in, I don't want anybody taking any trades. If you're gonna be trying to take trades, then yeah, don't take it inside this zone. Allow gold to play out at least until after 9:30. I probably will give a little bit of a pause during the training just to see where the live market is at. And if I can call out a trade and we have a nice opportunity, then hey, we make some money on the boot camp. But for right now, I am going to remove all of these. All right. And let's dive into the training. So what's good, everybody? Top of the morning. Hopefully everybody is blessed. Just to start off, for those of you who don't know me, because I know we have a lot of new people on the call, my name is Koze. I've been trading for the past 6 years now, and I have developed systems and tools, softwares, to help students, like if you're new to trading, to help you identify directional bias. That is the way that I trade. The only way that I trade with every market, every pair. I have studied the market, so I don't really, particularly subscribe to ICT and all these extra strategies. I kind of just have studied price action for the number of years that I've been trading. And in studying price action, I have seen that the market follows this general trend where we react off of daily levels so perfectly. And it's been going on since literally the beginning of the market. And when you do market research and you actually study how traders started off, was they would have a newspaper, because we didn't have technology back then. They would have a newspaper. That newspaper would tell them the stock's daily high, the stock's daily low, and where price opened for that day. Those were the 3 identifiers that anybody had. And they would go ahead and call their broker up and say, hey, broker, I want to get long on this stock. And they hold that for a day, 2 days, 3 days, a week, right? So they would have to contact their broker again, call them back to then close out of their trade. And they would see the market going down and down. And obviously the broker is telling them to hold it, right? So it was a lot more rugged back in the day, but now we have a lot more freedom. Even though we have a lot more freedom, the markets still follow the same patterns. We still follow these daily patterns. We react off of daily highs, daily lows, and the daily open. So this is what I have systemized to determine directional bias. That is the key to trading in my eyes, right? If you don't know where you're going, then how are you going to get there, right? Is like going into a car and you have the entire windshield just blanked out. You can't see where you're going, so how are you going to actually get to where you desire, right? So if your desire is profit in the market, then you first need to identify the direction in which you want to go to get that profit, right? So identifying directional bias was key, and that was my turnaround point in trading. So I actually started making money after losing thousands and thousands of dollars. And that's what I've developed into these systems. So I'm going to be sharing with you some of the systems, some of the new systems that I have. A lot of you are familiar with Koze, but I have some new systems, some new softwares that I want to show you guys. Um, and then we're going to be diving into the training itself as well. So to start off, I'm going to be showing you guys Koze itself. This is the first edition of the code that I've basically done based around my strategy. And this basically is going to show you your daily levels, the same levels that I just spoke about. It's going to show you your daily high, it's going to show you your daily low, and it's going to show you the daily open, right? It's a special zone in that daily open, a liquidity area that it's going to show you. So it's not the exact daily open, but it's an area of liquidity. And that's why it's, you know, sometimes very skinny like this down here, or very large like this up here, because it's an area of liquidity that is targeted with this indicator. So I'm going to zoom in so you guys can see the market a little bit more clearly. What I'm referring to when I refer to the daily low is going to be this bottom green line right here. And then sometimes we also have a red line. So it's either going to be red or green depending on the day's volume, right? So in this case, for this day is going to be, you know, July 14th, 2026, 2026. So this was last week, Tuesday, right? So this line down here is going to be our daily low. This line up here is going to be the daily high. And this middle line right here that has if I'm going to zoom in a little bit more so you guys can see, but it's more of a mesh, right? So this middle line is more of a mesh where you can see an area of liquidity and you see the 50% of that area of liquidity. And that's what that dotted line is. So that is the same thing as this up here, where we have this mesh and this dotted line in the middle as this area of liquidity's midpoint, right? Now, what happened on this day is this was a Sunday. So this was a Sunday market opened last week. When the market opened, we opened with a massive bearish gap in the market where the daily high of where this candle started never got broke. Like we never tapped back into this gap. So this daily high never got taken out. And that's why this daily high line is inside of the daily open area, because it was just a bearish candle on the day that started with a gap. This gap needs to be filled eventually, right? Eventually this gap needs to be filled. We tapped into this gap perfectly. And this is exactly what I was referring to at the beginning when I said the market reacts off of these daily levels so perfectly that there is absolutely no reason to go against it. There's no reason. The market has been reacting off of these daily levels perfectly for decades. So all I've done is developed a tool that can show you guys these daily levels so you can see these reactions for yourself, right? I can't make this up. This is the daily high from Monday, the 13th. This is the daily high from well, Tuesday, the next day, the 14th, right? So this is the exact same reaction, right? We can see how market chases these areas. Same thing here. This is the daily low from the 13th. This is the daily low from the 14th. Once we swept the previous daily low, what happened? We ended up pricing higher, right? I can keep going back and forth and showing you guys where we reacted off of these daily levels, right? If we drag this level out right here, we can see how once we broke above this previous daily open area of liquidity, that's when we were able to price back into it and continue higher. So all these levels are doing is showing you directional bias. And the way that it's showing you this directional bias is because if you are above your daily open area of liquidity, you're going to be looking for buys. Simple as that. If you're above your daily open area of liquidity, you're looking for buys. And if you're below your daily open area of liquidity, you're looking for sells, right? So an example of that is going to be right here. We can see that we had a trend, a mini trend building up, and then we broke that trend below our open area of liquidity. This is gonna be midnight on Tuesday, or like end of day on Tuesday, Asian session Tuesday, going into New York session on Tuesday. So if you were trading Asian session and you see that you are below your open area of liquidity, then you're looking for sells. How do you look for sells? I'm gonna get into that. We're gonna get into it. We're gonna do a full-on training. So same thing over here in the New York session. You broke back below in the New York session. What happens? You retested the same area of liquidity and then you continued lower. This is nice, clean moves, 200 pip moves that we're getting off of these areas, right? So we want to pay attention to these areas of liquidity. And that is why I said that we don't want to be getting into any trades right now, because we are directly inside the middle of this daily open area of liquidity. So we want to see how price plays first, which is why I said after 9:30 is when we're going to more than likely see gold give us a move either to the upside, or we're going to see gold give us a move to the downside, right? But we do not want to get in while we're in the middle of this mesh area. This is a no trade zone, right? Look again over here just yesterday. What happened? We were above our daily open area of liquidity, retested it, and continued higher. 250 pips. Retested it again, continued higher. 270 pips, right? Came back down, manipulated below it, came back above it. If you waited for the right opportunity, you could have caught another trade to the upside for another 270 pips. And I'll show you how to get these trades. I will show you how to get these trades. So let me know if we have any questions in the chat so far. So far, this is the foundation. We need to understand this before I get into anything else. We need to understand this first. I love when we have like smaller groups on the call because it's a lot more intimate. So if you guys are at work or something, let me know. Then I won't pester you guys. But let me know if you guys have any questions. If we're crystal clear, then we move forward. We have our daily highs, we have our daily low, and we have our daily open area of liquidity. That is what this original Koze is going to be showing us. Now, I also want to point out, let me just go over to DJ30 because we are about to hit that 9:30 move. So yep, DJ30 is already active. 9:30 is about to hit, and we are looking like we are about to continue to fly off of DJ30. So if you guys want to get in for any positions, I'm more confident in this DJ30 trade than gold right now because we are above our area of liquidity, and we can tap into this next previous daily level that was up here. So we're just going to be a little cautious. I usually don't take trades before 9:30 for DJ30 because 9:30 has a lot of manipulation. So even though I do have a bullish bias, I do agree with this bullish bias. We can see the market do something like this, right? Where we tap into this mesh area one more time, maybe even sweeping these lows just to price a little bit lower, and then we can see the market spike all the way back up. Because US30 does like to manipulate sometimes. So let's just wait until after 9:30, but I do have a more of a bullish bias right now. If we do break below this area and we start to price with a little bit of momentum, then we might be able to take advantage of this downwards move down here. Because if we do sweep these lows, then we're more than likely going to continue to fall. But all right, back to the training. So I'm going to go over to the gold chart just because I don't have as much drawings on the gold chart. But we are going to dive into Koze Cross. All right, bet. Let's go over Koze Cross real quick. So Cozy Cross is going to do the same thing that Cozy is going to do. It's going to show you the same levels. It's going to show you the daily high. It's going to show you the daily open, and it's going to show you that daily area of liquidity, right? Daily open area of liquidity. The only difference with Cozy Cross now, because this is a new software, so you guys have not seen this one as yet, or some of you might have seen it. But the difference with Cozy Cross now is you're gonna also have your EMAs, right? You're gonna have your moving averages, your 20 and your 50. So with these moving averages, you're gonna have crosses in these moving averages. And these crosses is where we get in for our trades. All right, so that is how Cozy Cross was formed. All right, so essentially what we're gonna see in Cozy Cross, it's only gonna show you the daily level for the first day, unlike Cozy. So if I were to turn on, the previous Cozy, then we'd see all of the previous levels on the daily highs and daily lows, and we can see all of those reactions. But if I turn that off, then we would only see the EMAs and only see that daily level for the current day that we're trading. That's just to make the charts a little bit more neat and to focus more on the cross itself, right? So you guys can study these crosses, because what we notice is that when we do have a cross, we usually have a retest. So this blue bubble right here that you see is going to be your entry zone for your buy, right? This is your signal for your entry zone for your buy. You see price has a resistance and breaks that resistance, which we're going to get into support and resistance and how to identify these areas. But we see that price broke the resistance, so we know that price has the ability to price higher than this area. So when we come back down into it, this would be our buy signal right here. All right, and that is Cozy Cross. So we do get those signals. Like we have one right here that is formed. So we are inside of the mesh, which is why, like I said, right now I'm not, favorable on any position. I want to see how price plays out first. But just to show you guys the exact same thing, I'm going to do a little bar replay so you guys can see how it works. But what we have at first is you are going to see a buy limit that is formed once you see your blue ball. So you guys can see that blue ball right in there. And then once the market gets down into that buy limit, we are going to notify that it is a entry, which happened right there. So that's when that buy limit turned into a buy entry, right? So that's how Cozy Cross works. And now let's get into, I'm going to cut everything off so we can go ahead and clear the charts. All right, cool. So let's get into it. Let me just go ahead and pull this out. All right, so let's get into it, guys. Today is day 1 of the training. It is 9:30. So I'm just gonna go through a little, just gonna check the markets really quickly. Just a little check. US 30 killed. US 30 killed. Yeah, those buys were super valid. That I called out. Okay, yeah, so we did not even sweep the lows. We just kept pricing higher. So if you guys remember from the previous trade signal that was called out, where is it? DJ30. Yeah, that was golden. So this is the power of Cozy, guys. This is literally what I've been showing you guys all morning so far. Is we're above the mesh, we get our signal, and I'm gonna show you guys how these signals get called out, so we can make sure that you guys are able to take these trades as well. Boom, great trade, most def. So I'm going to go ahead. Let me just go back to the previous charts, and let's get into this over here. Can everybody see the technical analysis getting started? Everybody can see this PDF? Yep. All right. Perfect. All right. So a foundation guide to reading price charts, recognizing structure, and building habits to support the calm method. All right. So what is the calm method? I'm gonna do a little. Let's go all the way down to the bottom and read the back of the book before we read the front. So let's go down here to see what is the calm method. Right? So before we get into the final notes, I just want to show you guys calm method is it's just the calm cozy method. How else could you be cozy if you're not calm? That doesn't make sense. You have to be calm to be cozy. So to be calm, you have to confirm your bias, right? So like I've been telling you guys all morning, what do I do? What do I do when I trade? I first identify the daily levels to determine the directional bias. That is the first thing that I'm doing because if I don't know where I'm going, then how am I going to get there? I want you guys to ask yourself that every time you're trying to take a trade, before you enter that trade, where am I going? Where am I going? All right, so confirm directional bias. That's C. A is align the entry, right? So you confirm your directional bias and then you make sure that your entry is aligned with that directional bias. So what does that mean? Let's go back to the charts. Let's turn on Cozy real quick. All right, so let's say we are in above our daily mesh. That is confirming our directional bias to say that we are looking for buys, right? Because we're above our daily area of liquidity, right? So we're looking for buys. Now, aligning your entry means that you should not be taking sells above your daily level of liquidity. That is what aligning your entry means, right? So if you're looking for buys, you should not be looking for anything else besides indications to get into your buy position. That is how it cuts out the noise, right? A lot of times traders get confused with which direction the market is going to go in, if this is manipulating down and this and that. A lot of times when you get manipulated, you'd be surprised if you just enter a position and that same anxiety, that same frustration that you feel when you're in drawdown and you might be at your limit, if you just enter another position and you ride that wave back up, you're going to be so happy. Now, I'm not saying to do this because sometimes you might just be buying further into the dip and the dip just keep dipping. But once you understand the market, once you understand market structure, you can understand that, hey, if the market is coming down and I'm still inside of my or above my area of liquidity, my daily area of liquidity, then that pull down is just a market correction. That's all it is, right? The amount of times that we've seen, look just now where we've hit, over 100 or just about 100 pips in profit, right? 150 pips in profit just to come all the way back down to an entry level, just to go all the way back up 150 pips in profit again. How much times would traders exit out of their position when it comes all the way down to their entry and then try to get in for a sell just to get wiped out in the direction that they wanted the market to go in initially? So that's number two, right? You have to first confirm your directional bias, and then you want to align your entry with that bias. Now, number three is we want to then lock in the trade, right? We cannot be scared. Trading is about taking risks. There are going to be risks involved. Driving, there are going to be risks involved. So you wear your seatbelt. That's what you do. And that's what we have to do here as well. We lock in the trade without fear and we wear our seatbelt. I call it a seat lock, stop loss, SL. You got to have your protection. All right. So after we lock in that trade, because that's just let's get it done. Let's just do it. Let's just throw it out there, right? You're committed to taking whatever risk prior to taking that trade, right? You already know that your market is in the direction that you want it to be in. You know that your trade is aligned, so you must lock in that trade, right? And now M, to finish off the calm, you must manage your emotions. That's all it's about. That's what trading boils down to. That is simply what trading boils down to. Managing emotions. Nothing else. All right. So just give me a second. I'm just going to pull up the charts on this next screen that I have so I can see if we have any crazy movements going on while I'm showing you guys this PDF. Because if we do have an opportunity, I will call it out. I'm gonna let y'all know now. I am not shy to call out the opportunity. US 30 is looking like it's a pretty juicy setup happening actually. Because we had another nice smooth reaction off of this level. My only concern is that we have rejected this previous area. And I'll show you, you'll see inside the training. So this is an area of resistance, right? And we rejected this area of resistance with a long wick. So if we continue bearish, if we're able to break through support areas, then we're more than likely going to see this market continue to fall. And that'll be a nice juicy trade to the downside. Yeah, that'll be at least over 200, 300 pips to the downside. So we're going to be cautious on US 30 right now. We possibly might get an opportunity to sell. We have to wait for us to break below our daily mesh. That's what patience is. Let's run it. So I'm going to get into it now, guys. Let's jump into the beginning. Let me know how many beginners are on the call before I really dive into like the full, because there's a lot of beginner stuff on this training. This is day one. And I am going to be going through it nonetheless, but just let me know who all are new to the markets, or if you're more experienced. I'd say just rate yourself 1, 2, 3, 4, 5, like whatever you feel like your experience is in trading. I'd say the highest is 5, just so I can have a gauge of the audience and know how to communicate my language. We got a 1, we got a 1, we got a 2, we got a 3. Do we have a 3? We got a 3. Yeah, there we go. Can we get a 4? All right, cool, guys. So, introduction. This guide walks through what technical analysis actually is, how to read candlestick charts, and the patterns traders lean on most when reading price, right? It's the same foundation the calm method builds on. Before you can confirm a directional bias, you need to know what you're looking at, right? That's all it is. What is technical analysis? Technical analysis is a practice of using historical data and current price action to think about what price might do next. Keyword might do next. We never know exactly what's going to happen. I have a lot of students sometimes they're like, oh, which direction is gold going? Oh no. I wish I could just tell you, but no, we always are making an educated guess whenever we trade. That's just what it is. We never really know exactly where the market is going to go, but based off of historical data, we're able to make those predictions. Instead of looking at a company's financials, it looks at the charts itself. So we don't look at, in day trading, at least what I do, I don't look at, what this company is buying and what this company is selling and how their revenues look on a day-to-day. I don't know. I just see the charts. The candlesticks is what I know how to read. That's the language that I speak, right? The signals, patterns that reflect how people are trading the asset are actually, or how people are trading an asset are actually behaving. It will tell you the future. It gives you a structured way to read the present. So that's all we're doing here. Fundamentals is basically just financial strength. So that's when we're looking at news reports. I don't really trade fundamentals as much. But to get into how to read candlesticks, because this is where we're really gonna get into actually understanding the directional bias and knowing how to follow it, knowing how to be able to get in for those entries, right? So how do you read candlesticks, right? Reading candlesticks is the first real skill in technical analysis. A line chart gives you one data point, the close. So I'm going to go over the line chart with you really quickly. This is going to be a line chart. We have multiple graphs in the market. We have the line chart, we have the candlesticks, we have Heiken Nishi, we have this Renko, we have line break, we have so much different charts that you can look at. But the two most common that you'll see is going to be Japanese candlesticks and the line chart, right? The line chart is going to show you the close of each candle. So it shows you the true volume is what a lot of traders would call it. If you ever hear anybody else maybe watching YouTube or anything, it's called a true volume, where the market, where that candle did close, right? But when you see the Japanese candlesticks, what you're able to see is you're able to see the shadow, or what we call the wick of the market, right? So this long candles, like this long area that swept this area that we see, if I was to move the indicator so you can see it clearly, this long wick that we see sweep this area, you won't see that happen on a line chart because it doesn't show you the shadow. It only shows you the candle close, which the candle close was right here, right? This candle closed right here. So what is a candle? A candle is going to show you the high. It's going to show you 5 points, right? It's going to show you the open, the close, the low, the high, not necessarily of the day. If we're looking at a daily chart, yes. But in this case, we're looking at a 3-minute chart. So on the 3-minute chart, it's going to show you the high for the 3 minutes, the low for the 3 minutes, right? And every time frame in between, it's going to show you that specific time frame, right? 5 minutes is going to show you the high for that 5 minute, the low for that 5 minute, right? And it's also going to show you the direction that the market is moving. So in a line graph over here, we can see that yes, price is moving down, but we can't see how many candles are actually going down. How many times did in these 3 minutes between here and here did we get a bullish candle versus a bearish candle, right? We can't see that direction. All we know is that price is moving down, price is moving up, right? So we would have to go over to our Japanese candlesticks to see this was one candle followed by 8 or 9 candles that all stayed in the same low area, right? So that is very crucial in understanding the Koze method as well. So as a rule, longer time frames carry more weight, so a daily or weekly candle reflects a lot more concise conciseness than a 1-minute candle does, which is why Cozy indicator is built to help you read structure across time frames instead of reacting to noise on just one. So what I mean by that, in terms of Cozy being able to help you adapt to different time frames, you do have full flexibility over your Cozy settings. So you can go over here and you can manipulate these settings to your liking. You can put your TP5 at, 1,000 pips. You can put your TP5 at 200 pips. If your TP5 goes to 200 pips and everything else goes to 200 pips, your whole regime is going to change. And I'll show you guys how that looks right now. So if I just wanted to say 200 pips for everything, then my entire regime is going to change, right? So you're only going to see this is my max take profit now, right? So you're able to do that if you do want to say, hey, I'm going to trade on a higher time frame. Maybe you want to look for a longer swing trade. Maybe you're looking to catch 800 to 900 pips on your first take profit level, and maybe you're looking to hold it for 2,000 pips or 3,000 pips. Maybe you're looking to catch all-time high moves, right? I'm not sure, but whatever you're looking for, you're able to take advantage of the settings over here. And then what you're also able to do is you're able to see how you made those changes and how that affected the daily performance, right? So if you did make some changes and you saw that, hey, my daily performance dropped, then maybe you want to change it back to the original settings, right? So I'm going to go ahead and do that really quickly so I don't confuse myself. So let's dive into support and resistance. I'm going to do a deeper dive into this as well. But support and resistance, let me check gold really quickly because somebody just messaged me. Yeah, gold is still not doing anything. We're still inside of this daily mesh. So these are like trap zones, right? That's how I look at it. We're in a trap right now. So we don't want to do anything. We don't want to get into this trap. We want to wait until price gets out of the trap, and then we can catch some fish. All right, it's easy. So we're gonna do a deeper dive into support and resistance, but it is the most fundamental form of trading, right? You have to understand your support and your resistance levels. So the same way that you see your daily levels, once you identify your daily levels and you're able to identify support and resistance within these levels, that is when that's when you're gonna be clutch. You're gonna be good because you'll know which directions you're looking for the market to go. And then it's easier to set your take profit levels, it's easier to set your stop loss levels, and that's when risk management is just emotional, right? So that's when we go down to that M in the calm method and we just learn how to control our emotions while we're trading, right? So let's go over support. Support is a price level where buyers have historically stepped in, and resistance is a level where sellers have historically stepped in. That's all it is. So resistance is going to be here. We see that sellers push the market down here, and we came back up. This is hitting a resistance. It's meeting some form of, ceiling, right? So that's how we learned it when I first started learning trading. We learned it as a house, right? So you have a floor and you have a ceiling. Your floor is obviously your support, and your ceiling is obviously your resistance, right? So if the market is reacting off of your support, you're gonna see that next reaction. That's gonna be your indication that, hey, I can get in for the market. We're reacting off of a support area, vice versa for a resistance, right? And then we have things like break of structure, which we'll get into as well. That's gonna be for day 2. Day 1 is just basic training, so that's why it's very fundamental today. But the markets aren't doing anything anyway, so I'm glad that today is the fundamental day. Um, but then we have breakup structures and then we end up retesting these areas. So a previous resistance can be flipped and turned into a support. So the way that you think about it, like a 2-story house. So if you have your support and then you break through your ceiling, right, on the first story, then that ceiling now becomes your support. So then you have another ceiling because you're now in the second story of that house, right? So these levels aren't fixed forever. When resistance breaks, it tends to become support. When support breaks, it tends to become resistance. The flip is one of the more reliable structure cues traders watch for when trading and is shifting rather than just pulling back. Right? So traders cap, this addresses not knowing what to look for is the first gap the calm method closes. Support and resistance are the starting points. Their levels, the levels everything else on the chart gets measured against, right? So we're gonna dive into support and resistance. Let me just pull up that PDF because I want to do that little deep dive before going further into this training. So let me know if you guys could see the support and resistance training. Yes, sir. Bet that. Let me know if you guys are getting some value, if you guys are learning something. Let me zoom in because I can't even see this myself. So I'm gonna be kind of breezing through this because you guys are all gonna have access to these PDFs as well. So I'm gonna kind of just breeze through this and speak over the main points of this kind of deep dive into support and resistance. But this is very, very important. So I definitely encourage you guys to actually go ahead and review this, study it, so that you can have a better understanding of support and resistance. But it is one of the most foundational skills, right? It's the thing that we learn first in trading. At like day 1, everybody talks about support and resistance, but you don't really understand and truly master it until you've been in the market and you've seen it so many times, right? You don't it's a different kind of feeling. So there's 3 mistakes, right? 3 mistakes that um to drop immediately, and that is hunting for the perfect line. This is something that a lot of my students at the beginning had a problem with, is because they try to find that perfect area Where is price exactly going to react? How can I not have any losses? I don't want to even see a cent of my account go in drawdown, right? This is where most traders are. They're trying to look for that perfect line. Can you find it? Absolutely. Sometimes you can, right? I've called it out multiple times, multiple screenshots of calling out just no wick drawdowns and just straight profits. It happens. We can get that precise for sure, but that is not what we're aiming for necessarily, because having that thought process before you take the trade is what's going to cause you to make a psychological error while you're in the trade. If you think before you take the trade, I don't want to take this loss, I don't want to go in drawdown, then if you do go in drawdown, subconsciously you're not gonna handle it as well as you would if you didn't care, right? That's just how our human minds work. When we, it's almost like the don't think about the elephant trick, right? It's impossible. I'm telling you about an elephant, and I'm saying not to think about it, you're thinking about an elephant. It just happens. If I say pink elephant at that, oh, it's even more drastic. Now you definitely thinking about a pink elephant. Because who sees a pink elephant, right? You can't not think about it if I say don't think about it. So the same thing for trading. If you say that you don't want to take the loss, you're gonna more than likely take that loss, right? So hunting for the perfect line, support and resistance are zones, not exact prices. Spending time trying to pin a level to the pip is a waste of effort. Price is driven by people, not machines. So the same level will never be tested the exact same spot twice. Now that it happens, and the market does not like that. So when it does touch the same spot twice, it's called an equal low. It can also hit an equal high. Those are seen as errors in the market, and they are typically mitigated very, very quickly. And if not, then when they are mitigated, they're mitigated very violently, right? There's a lot of liquidity built up in those areas, right? So the second mistake or kind of, misconception really is believing only wicks count, right? So wicks, remember, guys, are the shadows. So this would be the candle itself, right? And this would be the shadow. This would be the wick, right? So a lot of people think that only wicks count as support and resistance. That's just simply not true, right? So a level is broken, or a level broken by a few pips of a candle body isn't automatically invalid. In real market, price often pushes through a key level slightly before reversing, and that it's still valid. It's only strong, or it's often stronger, or levels to watch if it does do that. So simply here, this was like a false break. So it did price lower than these wicks. The body did price lower, but then we immediately came and shot right back up. So after that, we were able to see the market continue higher, right? So I'm sure you guys have seen this countless times where it break a low and everybody's thinking, okay, we're gonna sell, 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 and they start selling and then they get wicked out, and then they're like, okay, let's buy, and then they start buying and then the market drops again, right? So this happens because it's geared to happen that way. The market is literally geared to happen this way, right? And then the third one is marking every tiny rejection. That is something that a lot of traders do, and especially in the beginning, right? It's amateur trading things, marking every single level, every wick. So how that looks is clutter versus clarity, right? Amateur trader, this is how their charts look, right? Buys and sells up and down, up and down, up and down, because they have no clear direction. There's too many lines. It's hard to tell where the market is going to go. Professional trader, you have one line, you see how the market reacts off of this line multiple times. That's your highest probability setup. Oh, Sandy said that's how his charts used to look. Mine too. Mine too. To this day, I still like I clean up my charts because I'm like sometimes I just hate how my charts look. It just looks too messy. But you want to make sure you keep as clean charts as possible. This helps to keep your mind clean and clear of clutter as well, right? So this is the same price data, the same time frame. This is the exact same charts. It's just you can see who has more anxiety. That's what you can see, quite literally. As all is determining. So the third rule or three rules for drawing support and resistance like a professional is first identifying a proper rejection. Right? So we go back to the calm method. It's always first about confirming something. You first have to identify something. So many times people go into the market and they want to just trade to make some money, but they haven't identified anything yet. What are you trading for? Right? Ultimately, if you don't identify something, then you are gambling. And that's just being quite literally as raw as I can be. And when I say you're not identifying something, and when I say you're gambling, I tell my students all the time, if the clock does not say 00 on whatever time frame you're trading, you are gambling before you enter. If the clock does not say 00 on whatever time frame you are trading, you are gambling. Quite simply, because there's a lot of times, and I'm sure you guys have been caught in it. If for all my twos out there, my threes out there, maybe not my ones, but I'm sure even my ones out there, I'm sure y'all have been victim to this, fell victim to entering into the market thinking that, oh, we're about to get a bullish engulfing candle. I see it. And then the market just immediately wipes you out and it does not engulf. It doesn't engulf, but your emotions are so tied up in the fact that it almost engulfed that you still stay in that trade all the way until it's stop loss. Right? The amount of times I've seen, and I'm saying this because it's happened to me, right? Too much times. Too much times. We have to wait for the market to actually give us the data point. If the candle is not closed, then we do not have that data point. That's just as simple as it is. If we don't have that data point, what are we doing? We're gambling. If we do not have that data point, we're gambling. Right? Now, do gambles work? Absolutely. Do I gamble? Absolutely. But I'm not saying to gamble. I'm just telling you guys what you're doing if you are doing it. Right? I do it sometimes, I must admit. Sometimes it's exciting. We can get some wick entries, but that is not the point of it. The point of trading is to be precise. We want to make sure that we are following our risk management. So if you are going to gamble, gamble with a gamble account, right? Or gamble with a smaller entry, right? Scale into the trade if you have to. That saves, that saves some of my students, telling them just that simple trick and then following it, scaling into your entries can save you tremendously, right? So first you want to identify a proper rejection, right? So not every rejection deserves a line. A proper rejection has two traits. It spends more time moving in one direction and it covers more distance while doing it, right? You guys should be taking notes, hopefully. Excuse me, we have an hour left. We have one more hour left. If you guys have any questions, make sure you guys write it down. Let's check the markets really quickly because we have this 10 o'clock open. So gold is reaching to the bottom of this mesh area. We're looking like we're going to sweep these lows. Are we going to sweep and continue higher is the question. There is a fair value gap down here. We're going to get into fair value gaps and we're going to get into so much things, guys. I can't wait for tomorrow and Wednesday session. We're gonna get into so much, and I feel like the market is also gonna give us some opportunities. Today is just a Monday, but no, I'm excited. We're gonna get into fair value gaps. We're gonna get into Fibonacci's. We're gonna get into literally everything that you guys have probably been learning for all of you twos and threes, and hopefully you guys have some clarity on it. Yeah, so DJ30 has definitely came down as well. So we swept, like I said, this is such a beautiful sweep too. We swept this previous high, this resistance. So we can see this is a perfect example. Oh my days. Identify a proper rejection. Look over here. What is this? This is a perfect proper rejection. How else can we identify this? This is amazing. Perfect rejection in live markets, right? Now what we're waiting for is we're waiting for the market to now break below so we can calm, right? See, confirm directional bias. We're in the middle of the mesh. We need the market to be below because we have a sweep of a high. That's 2, right? 2. You must align your entry. Excuse me. 2, you must align your entry. Right, so if we have a sweep of a high, and that's a proper rejection, so we know we could potentially be looking for sells. That's what we're anticipating. So if we want to look for sells, we have to align our entry with that. We can't take the sell unless we're below our mesh area, right? And that means that we would be targeting to create new daily lows, right? That's all we're doing. So calm, see, confirm directional bias. We're in the middle, we wait for it to be below. Align your entry or make sure your entry is aligned, right? We have a sweep of a high. We have breaks of support. If you're breaking support, you're looking for sells. That is alignment, right? If we do not break the support, then we are continuing bullish. That's ultimately what we're doing. We're rejecting the support, right? So we have not reached number 3 yet. We have not reached to the enter your trades. We have not reached that stage yet. All right. We have not reached the lock-in stage. But we soon shall potentially reach the lock-in stage, maybe on gold, maybe on DJ30, depending on how this price moves. But let's dive right back into it. Wait, hold on, let me see something. Let me see something. Yeah, this previous 1-hour candle has no bottom wick, and this was a swing low. Now, the swing low was not a proper swing low. This is a false swing low. It's a false swing low because this did not happen at the lowest area. A swing low has to be the lowest area of price. So this is more than likely going to get swept. We're going to see this market price lower, and we're going to more than likely see this market take out this previous daily low down here. That is my anticipation for DJ30. I'm not taking a trade right now. What I like to see is confirmation for my bias. I don't like taking trades when there's a lot of liquidity to be swept up here. So I'd want to see price maybe play around a little bit more. Maybe this movement isn't going to happen until 11 or maybe a little after 11. But we'll see. If we do get a break of this support and we do get a bearish engulfing, then we might have a valid trade set up. So we'll keep an eye out for DJ30 and for gold right now. All right. Are these meetings being recorded? Yes, they are. If Deem is still with me. He should be. No, they should be still recorded. So yeah, let's get into proper rejection. So we can see that these all over here are proper rejections. Distance is what matters most. Even a fast 2-candle move can outrank a slower 10-candle one. So let's go into the live markets and show you guys what that means, right? This is 10 candles moving downwards, right? Hypothetically, it's actually more than that, I'm pretty sure. This is 16 bars. So this is 16 candles pricing downward. But those 16 candles pricing downward do not have more volume than these 2 candles that price downward. That is what you call a proper rejection. This is not a proper rejection of this level. right? So if I was to draw up a resistance like an amateur, right? If I was to draw up an amateur's resistance, it would be right here, right? And then that resistance would get swept because this is not a proper rejection. This is not a proper rejection, right? So this two candles that took out all of these candles has more volume and is considered a proper rejection over this kind of a move here, right? So that's all that this is saying over here. And it's showing you guys an example of it right here as well. So these smaller candles, if I zoom in some more, these smaller candles that were just eating up, eating up, eating up. While over here, these smaller candles that are just eating up, eating up, eating up, they're not proper rejections. When the market breaks an area, then we can possibly see a proper rejection happen after. This is just what we call accumulation of price. Accumulation of price, right? So more rejections equals stronger levels, right? That's the second thing that you want to look out for, right? So the three rules: identify a proper rejection, and number two, more rejections equals stronger levels, right? So once you identify one proper rejection, look for more. A level with several rejections behind it is called a key level. The rule of thumb is simple. Once a level has two proper rejections, you can trade on the third one, right? That's the general rule of thumb. There's a lot more technicals that go into it that we're going to learn throughout the whole boot camp. So don't just go and start taking these trades right away. You guys watch the full boot camp. They are recorded, so watch it again, study it before you start implementing these kind of strategies, because we are building, it's building blocks. That's what this is. So we have one rejection here, two rejections here. So the third rejection we could have taken, one rejection here, two rejections here, third rejection we could have taken. Once we break a area of resistance, that resistance now becomes a support. Remember, like I said, we're building on top of blocks. So we have a resistance, it breaks, it becomes a support, we retest it, and we continue higher. All right, so a stronger level is found out by by more rejections, right? So once again, we can see in the live markets. I'm just coming back to the live markets to show you guys exactly what we see happening. These are, you know, current movements, right? We have one rejection of a resistance right here. Proper rejection. It's a proper rejection because why? This is volume. We have volume in this rejection, right? We swept a previous resistance. We had volume. There's other indications as well that we'll go over in time. But the main thing right now is we have volume. We know we have volume because the market priced away from it for a long time, right? If we were to use our measurement tool, that's right over here, right? We see that price has moved for 2 hours and 50 minutes before pricing back up into this area. So that's a proper rejection, right? And when we price back up into the area, we rejected it again. So that is our second rejection. By the third one, this is our valid entry, right? And that's when we can take advantage of these sells, right? And golly, would this be a beautiful sell to take advantage of, right? So more rejections equals stronger levels, right? And number three, recent rejections matter most. So price reacts most reliably near its most recent rejections at a level. Draw your lines as close as possible to the last touch rather than the first, and expect to nudge it slightly as new rejections form. So let's go back to this example. We see that this is the first rejection, right? Remember, recent rejections matter most. So draw your lines close as possible to the last touch rather than the first. So this is the first touch. What's the last touch? The last touch is over here, all right? So we can see if we did price this at the high of the first touch, we would not have been able to got this trade. We would have got right to it, but we would have missed it. I know Alex is burning up right now because Alex just sent me a screenshot of him missing a trade because it literally pips away from the sell limit. Pips away. Just pips away. But we no longer got to be pips away when we understand price movement, when we understand that we take advantage of the most recent level, right? So this would be the second rejection, and that's the rejection we want to pay attention to. That's where we want to get our entry at this dotted line down here. That's how we're able to capitalize off these trades, right? So live market examples, this is just when, this is just last week Friday. So this is literally the previous day, previous day in the market, right? And we see this time and time again too. Like we have another 3 rejections right here. Very stable rejections, right? So we can see this time and time again in the market. Look right here again. 3 rejections. Third one is when you take your entry, right? These are common things that happen, but we have to identify first a few areas. We have to identify our resistance areas, our support areas, and our daily levels, right? So we can have a clear understanding. We are pricing lower, guys. I have not gotten into this trade. I'm more in education mode right now, but just showing you guys the power of like understanding directional bias, understanding when a level is swept and how the market is going to continue in that direction, right? That's how you determine directional bias. So let's jump right back into it. So recent rejections matter the most. Keep that in mind. All right. And now we dive into the simple way to spot support and resistance. And that simple way is just simply once you're comfortable identifying proper rejections, there's a much more simpler read. And that's 2 candle sequence that marks a turn in its simplest form. And that's what I always teach all of my students is that we have to see a bearish candle and then a bullish candle. That is a support. That is the most basic way that we see support. Bearish candle, then bullish candle. Support. We see a bullish candle, then a bearish candle. That's resistance, right? So to simplify it, support is simply form, or support in its simplest form is a bearish candle followed by a bullish candle. Sellers push price down and buyers immediately take it back up, right? And exactly opposite for a resistance, buyers push price up and sellers take control and push it back down. How to use it? These two candle read won't replace the rejection strength. Work on the previous page. It won't replace it. We have to tie everything together. Like I said, we're building upon blocks. So understanding this 2 candle is not just going to be, okay, every time I see a bearish and a bullish, I buy. It's not what it is. You don't buy at every support, but that does indicate a support. Right? You do not buy at every support, but a bearish candle then a bullish candle indicates a support, right? It's just the fastest way of noticing it, right? So with that being said, we have gotten to the conclusion of our support and resistance training. We're going to go back into the technical analysis training. Before we do that, let me know if we have any questions. But given how much every trade depends on it, drawing support and resistance well is worth the deliberate practice. 3 rules carry almost all of the weight. Only mark proper rejections, ones with real distance and time between them or behind them. I say between because we want to see like this distance, right? 2 hours and 50 minutes between this rejection, first and second. That's good, right? That's a long time. That means that we can see a far movement, right? So either behind or between, however you want to word it. Number 2, look for confluence. 2 proper rejections at a level clears it to trade on the 3rd touch. And then 3, weight the most recent rejection more heavily. and expect levels to mitigate slightly over time, right? And then we trade our calm method. That's all we have to always remember. We're calm and cozy. We're calm and cozy. Confirm, bias, align, entry, lock in trade, manage your emotions. That's all it's about. All right. So that concludes that. If we have any questions, I don't see any questions in the chat, so we should be good. DJ30 is on our rampage. Gold is still kind of at the same levels, honestly. Gold and DJ30 are pricing almost similarly right now, where we're at the bottom of this mesh, but we have not broken support as yet. We have not broken support as yet. So it's about understanding that as well. Even though we're below, we haven't broken support, and we do have a whole lot of imbalance at this area of resistance, right? All of this is imbalance up here at this area of resistance that we could mitigate before continuing to price lower, right? So we might need to take advantage of the second opportunity after it breaks below this level versus the first opportunity, right? It's just a matter of watching to see how price moves before we make any decisions. So diving back into price action, because we got about 40 minutes left on today's training, and I got a surprise for the end. I'm just going to show you guys one more system. But common candlestick signals, right? So we have the hammer candle. I'm just going to show you guys these. We can read through it when you have your PDF, but we have our hammer candle, right? This is signaling potential buys. We have our shooting star. This is the exact opposite of how a hammer looks, right? So the hammer is going to be when price pushes down and then pushes back up, right? So we have a shadow to the downside, a wick to the downside, and barely any top wick or no top wick at all up at the top of that candle. That confirms a hammer candle. And a shooting star is the exact opposite. Now, one thing you want to make sure that you pay attention to is that there's no confusion to the left of you going on over here, right? So we can't see what's going on past this red candle here, but assume that on this other side of the market, I can push my cursor all the way to the far end of my screen, and there would be no candles to the left of me, right? That is what makes it a proper rejection and a proper hammer, right? If there's a lot of choppy movements to the left, or maybe there's support that was broken before this candle forms,
He wants to punch
then you
it.
have to be a little bit more
Punch the wire.
cautious, right? Then you have to be a little bit more cautious, right? So we want to make sure that to the left of us, there's no, confusion going on. Same with the shooting star. To the left, we want to make sure that there's clean price action. So if I were to go over to the live markets and I were to find an example of this kind of a trade, because I know I can. Look at this, right? A hammer is going to be a long wick with a little to no wick at the top. That is this candle right here, right? That will be a hammer candle. When you go to the left of it, there's nothing else going on, right? We just rejected off of a previous support level, but there's nothing else going on. So that means that this is the lowest point that the market is coming to. That signals that it's a proper hammer. It has to be the lowest point, right? And then the same thing for a shooting star, right? Like this example over here. For this session day, we see that this is the break, right? So this is the previous day, the Thursday, before 6 p.m. 6 p.m. happens, and then this is now the Asian session on right before the new session or the new day, right before Friday, 12 a.m., right? So what we see happen here is we see that shooting star, right? That shooting star candle. So you can see that clearly that there's nothing to the left of it, and that makes it a proper shooting star, right? So let's go back here. We also have the bullish engulfing and the bearish engulfing. These are the two candles that are, these are my bread and butter. These are my bread and butter. This is what your Koze is going to be indicating as well, right? We're going to see some bullish engulfing candles, some bearish engulfing candles, and we're going to get some trade signals called out. We're going to get some buys called out. We're going to get some sells called out, right? So these are very, very, very important. The way you identify a bullish engulfing candle is that a bullish engulfing candle happens when you see a small bearish candle and then a larger bullish candle, right? A larger candle pricing higher, right? So a small candle pricing lower and a larger candle pricing higher. That is bullish, right? If it's bullish, it's pricing higher, and if it's bearish, it's pricing lower. So the exact opposite for a bearish engulfing, we have a small candle pricing higher and a larger candle pricing lower. So we're looking for sells, right? Now, no single candle tells the whole story. These patterns are inputs into a directional read, not a trigger on their own. That is exactly why a line comes after confirm in the CALM method. The signal has to line up with the borders bias, with the broader bias, before it means anything. So if I see a bearish engulfing right here, right? If I see a smaller bullish candle and a larger bearish candle, but I'm ultimately looking for buys because I'm above my daily area of liquidity, then I'm not interested in this bearish engulfing. Because why? It does not align with my confirmation. We have to trade in alignment with our confirmation. So my confirmation is for bullish moves. So I want to see bullish moves above my area of liquidity. All right. Now, the second key thing is that we do not want to be buying at areas of resistance. We want to be buying at areas of support. So that's another just key factor that we want to keep in mind here. So then that way you're not buying after this massive bullish engulfing, because this massive bullish engulfing came into a resistance area. So that is how we avoid taking losses. Koze is an algorithm. It's going to call out the bullish engulfings. It might call out a trade off of this bullish engulfing, even if it's out of resistance, right? But it's going to do that and it's going to correct itself afterwards, right? But you, if you're analyzing the market, you might not have to take that loss, right? You might not have to take that loss if you understand, hey, I'm out of resistance. There's no reason for me to buy. The only way you buy is if you break that resistance and retest it as a support, right? That is what validates that move. So let's get back into it on the bullish and bearish engulfing side. Well, I'll show you guys an example of one basically here. We can see this is a massive one, but it's kind of a little bit more on the sloppy side. But this is a cleaner. Well, it's inside the mesh. Let me find one that's outside of the mesh. So bing, like right here, right? Right here, we're outside of the mesh. We're below it, but we reach this area of support. So if I'm just studying price action itself, I don't have to take this trade, but I can wait. We got above it, but we never got a bullish engulfing out of support. So let's go with the bearish engulfing since we're at the resistance anyway. So we're looking for a bearish engulfing below our mesh, right? So we drop below the mesh, we're able to break below support, and we can see that clear as day, right? This is our previous support level. Why? Because support is a bearish candle, then a bullish candle. Bearish candle, then a bullish candle, remember? Right? So support and resistance, that's the last thing we studied. bearish candle, then a bullish candle gives you your support. If that support is broken, then now we're looking for sells, right? We're already aligned because we're below our mesh. We confirmed our directional bias below our mesh. Now we're making sure that our alignment is there because we broke below support. And now we see our bearish engulfing. This is our lock-in. This is when we lock into the trade, right? This is when we take that sell signal. When we have our support, our stop loss above the previous resistance, and we have our take profit at the next level of support. All right. This is the previous level of support. Remember how I said support is not a line, it's a zone. So this is the previous level of support. You can TP anywhere inside of this level. All right. So that would be a perfect example of an engulfing candle to the downside, and then an engulfing candle to the upside would be over here. We are above our mesh. We have support, right? And we have this engulfing candle right here. We have multiple actually. We have one right here, one right here, one right here. So multiple bullish engulfings, one right here off of this one support level. And then the market shoots up drastically, right? For over 600, 700 pips, right? So that's just off of understanding support and resistance, daily engulfing and daily levels, understanding the daily open, the daily low, the daily high, and understanding candlesticks. 3 very, very basic things can get you 700 pip moves, 200 pip moves, 500 pip moves, using very, 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 very basic rudimentary trading knowledge. Support resistance, candles, daily levels, right? Now, to avoid all of the cluster, all of the confusion that could arise, that's what Koze is designed for. Because it shows you these levels without you having to put in the guesswork, without you having to go and find these on your own. It shows you the entries for the trades without you having to go and find it on your own. It shows you the win rate so you know if it's a good day or if it's a bad day and if you should stay out of the market or if you should, double down. All right. So it shows you all of that data. Now, getting into common chart patterns, we're nearing the end of day 1 training. We are getting close to the end of day 1 training. So we're gonna go over this kind of quickly because I don't normally trade. I wanted to put this inside of the training so you guys can see it because I know it happens very frequently. But I don't necessarily trade patterns as much. I trade what I just showed you guys. I literally trade what I just showed you guys. Daily levels, support resistance, and our candles, right? Now there's some more technicals that go into it and understanding market structure, but we're going to get into all of that in the coming days of this training. So let's go over Head and Shoulders is going to be a reliable structure signal for an uptrend reversing into a downwards trend, right? So if the market is trending upward and we get a Head and Shoulders, this is going to indicate that the market is potentially reversing. One dominant peak, the head, sits in between 2 lower peaks, the shoulders, right? So we see our head right here and we see our shoulders over here. So that is exactly how this looks right here. Just to show you guys on the live charts, an example of a head and shoulders. We have this move right here where we have our right shoulder, right? Price came down. We have our head, right? We can see our head is higher than our right shoulder. Our head is also higher than our left shoulder, right? Our left shoulder does not have to be equal to our right shoulder. That is one key factor that you want to Keep in mind, you do not have to be equal. Your shoulders can be like, little, you could be awkward with your movements. Trading is not just black and white. Right? So they don't have to be equal. Once you have a head that is higher than both the right and the left shoulder, that is a valid head and shoulder pattern, right? But the thing that validates this pattern is breaking the neckline. Your neckline is going to be the support formed by your right shoulder. The support formed by your right shoulder is your neckline, right? So this right here is our support. Ironically, how beautiful is it that our support is also our previous daily open area of liquidity for our cozy zone. So you don't have to, it takes out the guesswork, guys. It takes out the guesswork. You're able to see the market react off of this level, break through, retest, and beautiful trades to the downside. What do we want to wait for as a confirmation? We want to wait for the rejection. We want to wait for a candlestick pattern that we can recognize. That candlestick pattern would be, maybe let's say it's an engulfing pattern, because that's what it is for me, right? You guys can have whatever you want to look for, but I look for engulfings. Look at that. A quick 100 pips with zero drawdown. Because why? We waited for our confirmation. We were patient and we aligned ourselves. So I don't typically trade patterns, but I just wanted to show you guys like how you can trade patterns. The exact opposite is an inverted head and shoulders. So an inverted head and shoulders looks something like this, right? This is all recent market, guys, all recent market. That's going to be our left shoulder. This is going to be our head, right? That's lower than our left shoulder, right? Our head that just so happened to also be can somebody type it in the chat? I hope somebody was paying attention. What was this candle right here? If somebody types it in the chat, I don't know, I don't know how to send y'all money. Hammer, there we go. Beautiful. Beautiful. All right, Nadine, you got it first. So next time I come to Halifax, I owe you $1. But we have our head right here, and then we have our right shoulder right here, right? Our right shoulder and our left shoulder, like I said, does not have to be aligned, but the head has to be lower, right? And then we see the market price higher. So pricing higher, we want to see it break the neckline, which would be, in this case, for an inverted head and shoulder, our neckline would be right here, right? Because our neckline would be the resistance formed from the right shoulder. Now, when you see that break, now what we're waiting for, right? What we're waiting for is that confirmation. So we're looking for a bullish engulfing candle this entire way down. That's all we're doing, waiting for our bullish engulfing. We never get it, but hey, we did get a perfect rejection of our daily area of liquidity that Koze called out. Beautiful rejection of it. That confirms that, hey, we are still in a bullish market. So what do? We still wait. We still watch. We get our bullish engulfing candle right here. And look how beautiful this market played out. 40 pips drawdown, 100 pips easy. 100 pips easy squeezy. Easy squeezy. All right. Yeah, we priced back into the mesh. I had a feeling like today was gonna be a Monday. So yeah, today was a Monday, quite literally. So yeah, we didn't do anything today, which is amazing how we were able to get in a pretty decent training session in. But that is gonna be a head and shoulders. If we're crystal clear, we're crystal clear. How come you don't consider the first bullish engulfing after breaking the neck? So this breaking the neck, good question. Breaking the neck, right? Remember what I said earlier, Nadine? We are at a resistance, right? So we never want to get into buys at an area of resistance. We want to wait for our market to get to our areas of support. So our areas of support is automatically going to be down here. That's where Koze identifies our daily area of liquidity. That is going to be where our support is. All right, so we retested our support, and then we're able to see, yes, we did get our bullish engulfing up here around 2 a.m. right? Great question. So perfect. So outside of the head and shoulders, like I said, on the other module, remember how I said that we do sometimes get that equal level, and it's called a double top or it's called a double bottom. So, right, a double top forms when price peaks, pulls back to a support level, and then rallies to retest the same peak and rejects it again. That is a double top. So it looks like this in this diagram. We peak at this level, we come back down as a pullback, and then we rally back up to retest that previous level, and then price is lower after. The exact opposite is for a double bottom. Double top is going to be something like this, you can say. And remember how I told you guys, when we do leave double tops, the market doesn't like that. Um, the market likes to take those double tops out relatively quickly, and when it does, it takes it out very aggressively. So look what happens here. When we break above that double top, we shoot up aggressively. We just broke it for 50, 60 pips up before it started to drop, got a little bit of a pullback, 40 pips or so, and then shot up again for 150 pips, right? So double tops, double bottoms, the market doesn't like it. It sees it as an imbalance or as a correction that needs to be mitigated. But when it does move away from it, when it does break a certain level, you can take that as a signal to um, get in for a trade. So in this case, this was a double top, right? So this is one area. Then when the market came down, came up, retested that area again. So we rallied back up to that area again. And then we had a support form right here. This was a support level formed, right? And when we broke below that support level, that is when we can get in for our trade, right? That's the neckline right here. This would be the neckline right here, right? And now we break below, we're able to take advantage of sell opportunities, right? 200 pips to the downside. Hopefully this training is making sense for you guys. I'm breaking down the most basic topics for you guys in trading. But they're the topics that are, I feel, most misconceived, or there's a lot of misconceptions around it, because a lot of people don't study the market structure and they don't know the directional bias. They'll see a double top, but they don't know if they're above an area of liquidity or if they're below it. Koze tells you if you're above or below. Is that double top valid or not? Right? Things like double tops, you can get above your daily mesh if you understand that, hey, I just rejected a daily high and I got a double top. I just rejected a daily high and I got a head and shoulders pattern. I just rejected a daily low and I got an inverted head and shoulders pattern. Right? You can see the market, and it's so much clearer when you have Koze on your side. Right? So a perfect example, literally right here. This was a daily low right here. And what happened? We came back down. When we played at that daily low, what happened? We broke it violently, came back up, shot up and broke a resistance, indicating that, hey, price can go higher. Then we came back down, created a head, came back up, created a shoulder, came back down, created our right shoulder, and we were able to take advantage of a buy opportunity around here to get that move, right? All of that had to line up just based off of us understanding this little structure point right here, right? So a lot goes into it, but understanding the market movements is crucial. Now, common technical indicators, I'm going to breeze through this because this is something that you guys can study a little bit more on your own, and just play around with this a little bit more on your own. And if you have questions, definitely let me know. But we have our common technical indicators. We have our relative strength index, which you guys will see a lot of if you watch other traders. Me personally, I don't use these. But I do want to show you guys because a lot of times you're studying, going on YouTube, watching other traders, watching other things, and you might not really understand how to properly use these tools. And I want you guys to be able to have a good understanding of it, so you're not, um, you're not taking unnecessary losses, right? So we have our relative strength index. This is going to be our RSI, momentum oscillator, that measures whether an asset has moved too far or too fast. It runs on a 0 to 100 scale. Reading above 70 typically flags potential overbought conditions, while reading below 30 flags potential oversold conditions. Now, me personally, when I used to trade RSI, I went for 85 and 25. Those are my levels. I didn't do 70 and 30. They were two manipulations. They were, ugh, I hated them. I kept getting faked out with these 70s and 30s. So I usually do 85 and 25, but I did not remove my 70 and 30 area because a lot of times we would get the market to retest into those 70 and 30 areas after it already confirms the rejection. So the true rejection would happen at like 85, sometimes 90. Sometimes it goes to 120, like crazy numbers, right? So it's like off the charts technically, right? So, but typically around that 85 price, that's when I'd see like those reversals, and that's when I would start to look for them when they hit 70. So I'm looking for when the market can potentially give me a reversal signal. A reversal signal would be like we showed you before, the proper rejection, the candlestick patterns, or the chart patterns, right? But those would be our proper rejections. So what we're looking for, if it's oversold, if it's above 85 or above 70, you're looking for sells. If it's below 30 or below 25, you're looking for buys, right? And divergence is also worth noting, but we're going to get into that a little bit later on in the course. That's a little bit more advanced. Um, moving averages and MACD is also going to be something I'm going to get into later on as well as Bollinger Bands. I don't want to get too deep into these for the basics training course. So the final notes is going to be this. This guide covers the fundamentals. There are many more indicators and patterns worth learning as you build experience. No single pattern or indicator is right every time. Defined risk management, not certainty, is what keeps a losing trade from becoming a costly one. I'm gonna repeat that one because a lot of people might need to hear that twice and three times. Defined risk management, not certainty, is what keeps a losing trade from becoming a costly one. Look for confluence. Setups where 3 to 5 signals line up tend to hold up better than setups built on just one or two, right? And then just remember the Koze method, guys. Remember the Koze calm method. Confirm your bias, then align your entry. Lock in your trade, and then manage your emotions. Nothing else to it, right? Hopefully, you guys are getting value from this training. I am super, super stoked for tomorrow's training. I hope you guys are stoked for tomorrow's training. I know it could be a little bit of a lot of it when it comes to my education, but hopefully you guys had a good understanding of what's been going on. We didn't get any real market movements so far. We did break below on DJ30, but I'm not taking the sell signal because I have a good eye and I can see that this is a daily low. And if we're reacting off of this daily low again, we might price higher, right? We could be rejecting this daily low. So I'm watching this daily low. If we do break it, then that gives me a little bit more confirmation. But remember what I said, guys, I always wait for these levels of liquidity to be mitigated first. I don't like when we leave fair value gaps, which we'll get into in tomorrow's training. We're going to get into those fair value gaps and identifying those precise entries where you can get in and then get out. Learning how to get in and learning how to get out. All right, so that's going to be tomorrow's training mainly. A little bit more advanced concepts. So come ready, come prepared, come with your notebooks, pens, and questions ready to go. Let's run it, guys. Let's run it. I am done for today's training. Tomorrow we're gonna dive into a lot more, but hopefully you guys got some great value. Appreciate you guys hopping on. And let's continue to kill it. Take care, guys. Bless up.